It's a new day, another opportunity to have current and relevant business conversations, and it only happens here on Business Morning, right on Channels Television. I'm Ini John Mekwa. We start off with commodities space. Now, Uganda's coffee exports plummeted 28.5% year-on-year in August. It was hurt by a drought that blighted crops in parts of the country and squeezed yields. And the coffee industry regulator made this announcement. According to Uganda Coffee Development Authority, the East African country shipped a total of 501,054 60 kg bags of coffee in August, compared with 700,990 bags exported in the same month last year. The decrease in exports was mainly attributed to lower yields this year that were characterized by drought in most regions. The drought led to a shorter main harvest season in central and eastern parts of the country. And of course, this affected yields. Uganda, which predominantly cultivates Robusta, is Africa's largest exporter of coffee, followed by Ethiopia, and earnings from the beans are one of the country's largest sources of foreign exchange. Oil rebounded on Thursday after sliding a percent in the previous session as concerns over tight supplies heading into winter eclipse fears of a global recession. Brent crude futures rose by 50 cents to $90.33 a barrel, recouping their losses in early Asia trade, while U.S. West Texas Intermediate crude futures rose by 45 cents to $83.39. Both benchmarks fell to a near two-week low on Wednesday after the U.S. Federal Reserve raised interest rate by 75 basis points for the third time to tame inflation and signaled that borrowing costs would keep rising this year. The market had priced in rate hike expectation, and the announcement from the Fed did not generate much surprise. Meanwhile, some Chinese refineries are considering increasing runs in October, eyeing stronger demand and a potential reversal of Beijing's fuel export policy, which could boost crude oil demand. But oil prices remain under selling pressure due to inventory stock builds and a worsening economic outlook. In Nigeria, the national president of the Petroleum and Natural Gas Senior Staff Association of Nigeria, Pengasson, Mr. Felix Osifu, has said that security officials are complicit in the oil theft and illegal bunkering of crude oil in the Niger Delta. He was speaking at an investigative hearing on oil thefts by the Senate Ad Hoc Committee on Oil Lifting. Mr. Osifu said that no meaningful change can be effected without the security agencies. Also at that hearing was the Nigerian Upstream Petroleum Regulatory Executive Commission, Mr. Jide Akinola, who put the revenue lost by Nigeria due to oil theft to about $2.1 billion between January and August 2022. So we'll take a breather now, and after that we do have conversations in the commodities space, especially reactions following the hike of interest rate by the Federal Reserve. welcome back. The Federal Reserve of the United States hiked interest rates by 75 basis points. The Bank of England meets today and is expected to hike between 50 and 75 basis points also. Nigeria's MPC meets next week, Monday and Tuesday, and is expected to hike interest rate, and it's all to curb inflation. But what impacts follows all of this? We have Ajisola Sumoni, analyst with Financial Derivatives Company, joining us from Reading. Hi, Ajisola, good morning. Thank you so much for your time this morning. So this 75 basis points hike by the Federal Reserve is no surprise. I think we saw it coming. But I think what we should be counting now is the spilling effects on different economies, different currencies, especially the pound. The pound dropped to 37-year low yesterday. So these are some of the issues that we'll be looking at following this hike in interest rates.
Indeed, thank you for that question. Like you mentioned, the U.S. Fed increased the benchmark interest rate by 75 basis points, bringing the range to 3.3 to 3.25%. And this did not come as a surprise. The market expected it and they priced it in. What actually comes as a surprise is a fresh expectations of 125 basis points increase going forward before the end of the year. And so we expect that, by the end of the year, the U.S. Fed interest rates would be around 4.25 to 4.5%. And like you mentioned, this also has significant implications. One is the increase in cost of borrowing. Now, this is not only the United States. The Bank of England today at its meeting is expected to also increase benchmark interest rates by around 50 to 75 basis points, like you mentioned. In Africa, we're also expecting some aggressive tightening of monetary policy. In Nigeria, we expect some tightening. In South Africa, we expect some tightening. In Egypt, we also expect some tightening. So what we are seeing is a global tightening of financial conditions, and this has significant implications. On the one hand, it has the implication to increase the cost of borrowing, which would weaken economic activity and further increase the risk of a recession. On the other hand, we also have, still on this risk of recession, there's also the risk that, this increase in benchmark interest rates globally, or this global tightening of financial conditions would also weigh on oil demand, which we are seeing is affecting oil prices currently, is trending downwards. For emerging markets like Nigeria, I think there are also far-reaching implications, not just the current increase, but the tightening in global financial conditions. One is increase in a cost of borrowing, whether to get new credits or even to service existing credits. For Nigeria, we're also seeing a stronger US dollar, because typically when we have a risk of sentiment in the global market, we see investors move towards US denominated assets, which are generally seem to be safe assets. So we are seeing we are likely to see some capital flight from emerging market economies, which is also going to mount pressure on the external reserves and the exchange rate. We're also likely to see, because also this, in line with tightening of financial conditions, we are seeing a stronger US dollar. That is also going to increase the import costs for developing countries. So in general, for a lot of emerging market economies, we're going to see pressure on the exchange rates. We're going to see higher borrowing costs and higher cost of servicing existing debt.
Yeah, that issue of servicing debt is a big issue in Nigeria, because already our debt servicing is higher than our revenue. So, and then even for next year's budget, there's the plan to borrow more than 11 trillion to fund the budgets, so, and most likely going outside the country, we're dealing with dollar again, and with a stronger dollar, of course, that's even more for us.
Indeed. I mean, it also depends on the composition of the borrowing, right? If most of it is going to be foreign borrowing going through the Eurobond market, or borrowing from multilateral organizations, which I think the federal government is going to go for, then we are going to see even a further increase in debt servicing costs. But even when most of the debt is going to be locally denominated, then we are probably going to see borrowing from the domestic bonds market, the domestic securities market, and also borrowing from the central bank. So I think it depends on the composition, really. But like you mentioned, the debt servicing to revenue ratio is really, really poor. I would say that.
Okay, so we also see that the LNG, liquefied natural gas, is still soaring. What's driving that?
I think what traders are at the moment, traders are literally weighing sentiment, right? Because on one hand, they are weighing the capacity of the EU to shore up, natural gas in anticipation of the winter versus the possibility of a supply crisis in the winter. So far, we are seeing huge increases in LNG stockpiles in the European Union. We are seeing, I think currently the storage of natural gas in the European Union is around 86%, which is above 5-year average, which is good. In addition to that, we are seeing huge imports coming from the Middle East and Asia landing in EU. So that is good, because I think what is happening is the European Union are kind of they're beating the curve. They're anticipating a cold winter, and they're trying to prepare in advance so that there won't be a supply crunch. But there are still some huge risk factors. One risk factor is that Russia could further cut off supply to the EU, which it did recently with the Nord Stream line, which goes through Germany to Europe. So there's that huge risk. There's also the huge risk of a colder than expected winter. I think if these two risks materializes, they will probably see we're probably going to see natural gas prices spike further. However, we are seeing governments, European governments, inject liquidity into the energy sector in order to kind of reduce the impact, or to ameliorate the effect of these higher LNG prices on the domestic economy, and as well as to reduce the effect of a possible technical recession.
And then also soaring is the wheat prices up more than 1%. I thought the release from Ukraine to the Black Sea would taper down the price of wheat.
Indeed, these are mainly driven by sentiment, technical factors, right? Sentiment. What is happening is what the media is calling the annexation agitation. Essentially, the idea is that Russia is now moving to formally create annexes in Russian captured regions of Ukraine, and this signals to the market that the Russian invasion of Ukraine is not going to end anytime soon. It's almost 7 months old now. It has been on for 7 months, and the fact that Russia is formally going to establish camps and bases in these Russian captured areas of Ukraine simply suggests that this is not going anywhere anytime soon. In addition to that, we are seeing also warmer than expected weather in a grain region in the United States. Typically, wheat is a cold weather commodity. So when we are seeing warmer than expected weather, it kind of affects the harvest, and that's part of why we are seeing the prices soar. For Nigeria, I think the impact is quite huge. Couple the fact that wheat prices in the global market are trending upward with the stronger US dollar. By the way, the dollar has strengthened against the basket of currencies by around 16% year to date, and yesterday it increased by around 1%. So combined elevated wheat prices with stronger US dollars means for Nigeria higher import bill. Take into consideration also that Nigeria imports a huge portion of wheat that are used in production of pasta, flour, and many other commodities. So many of these commodities, the prices of many of these commodities are likely to remain elevated in the near to medium term. Provided this Russian invasion of Ukraine persists, the price of wheat is also going to remain elevated, and import bill as well as the domestic prices are also going to remain elevated.
Yeah, talking about the war, I think a lot of both currencies and commodities also reacted to President Putin's statement when he talked about the nuclear blackmail from Europe, and saying that he's ready. And I think he has some new recruits or something like that, about 300,000 of them. A lot of commodities, economies and currencies also reacted to that, because it looks like the war ain't going nowhere so soon.
Exactly. I mean, this is what we call a contagion effect, right? Because of the global, the world is kind of like intertwined, right? So because of Russia and Ukraine also are huge producers of commodities, wheat, corn, energy, oil, natural gas. So the fact that Putin said, made those statements, the statements about the nuclear weapon, the statements about new recruits, it simply suggested, like you mentioned, that the war is not going anywhere, that this is a prolonged affair, and Russia really means business. So many of these prices in the commodities markets are going to remain elevated for the near to medium term, and central banks globally are going to have to, global financial conditions are going to tighten also to stave off inflation. So I think what is happening right now is because of, the war is not ending anytime, so we don't see, Putin doesn't seem to be open to negotiations or negotiated end to the war anytime soon. So it's like this is going to persist, and this because of Russia's place in the global commodity space as well as Ukraine, commodity prices are going to remain elevated. Energy prices, the price of oil, price of natural gas are going to remain elevated. This is also going to feed into global inflation, and as a response, central banks of global central banks are also going to, increase interest rates aggressively in order to, bring down interest rates. So we expect that global financial conditions are going to be tight up until at least 2023. Already, the U.S. Fed has forecast that, they see their benchmark interest rate being around 4.5 to 4.75% at the end of 2023. So we are likely to see, elevated interest rates and tighter global financial conditions going into 2020.
And the World Bank has warned that as long as central banks keep tightening the monetary policy and the flow of liquidity, there's most likely going to be a global recession by 2023, and that's just going to worsen everything.
Indeed, Ini. I think it's a trade-off, right? So it's either, you're losing financial conditions to stimulate economic activity, to achieve economic growth, or you tighten economic conditions to kind of stave off inflation. I think I think the central banks globally are kind of choosing to tackle inflation at the moment, because for many of these developed countries, I beg your pardon, inflation at record levels. In the UK, we are seeing inflation at 40-year high, currently at 10%. Meanwhile, the long run target rate is around 2%. Same with the United States. We are seeing inflation also at record levels, many percentage points above their target level of around 2%. So I think they are not used to seeing, the central banks are not used to seeing inflation at this level. And at the meeting yesterday, the president of the US Fed said that there's no painful way out of this, as they are increasing the benchmark interest rates. They also expect they expect economic activity to slow down. They also expect unemployment to increase at the same time. So there's no silver bullets. There's no painless way out of this. I think at this point, with the tightening of global financial conditions, I think a global recession next year, I think it is almost inevitable at this point.
Yeah, so it looks like these are the days of high inflation, high interest rates, and most likely double, at least for a lot of African countries. Nigeria is 20 plus, Ghana is 30 plus, Turkey is 30 plus. So these are the days of high interest rate. But what else is happening in the commodity space?
I think one important factor in the commodity space is the price of cocoa, and that is because we are seeing larger than expected rainfall in major growing areas in Nigeria and southwest of Nigeria, as well as Ivory Coast. And this has the implication of reducing harvest, because on one hand, because of the excessive rainfall, the soil has too much moisture, which creates like enabling conditions for black pod disease, which is going to affect the harvest. In addition to that, because of the excessive rainfall, the farmers are not able to properly dry the cocoa. So all of these factors are going to contribute to reducing the harvest. So we are expecting that the price of cocoa is actually going to increase because of this excessive rainfall in major growing areas in West Africa. All
right, Adesola Asumani, thank you so much for your analysis this morning, and enjoy the rest of your day.
Thank you.
All right, we'll take a break now. After the break, we're still staying in, of course, Nigeria, Africa, and we'll be discussing risk reward. That's after the break here on Business Morning. Do stay with us. Welcome back. The Africa Risk Reward Index is an authoritative guide for policymakers, business leaders, and investors, and reports that after effects of the COVID-19 pandemic and, of course, the Russia-Ukraine war, projected to impact the African continent's economic outlook for many years to come. And Africa finds itself in the midst of remarkable uncertainty. To help us understand the dimensions of this uncertainty, we have joining us as part of those who put up that research, Zainab Animashao, Senior Analyst, Control Risks, joining us now. Hi, Zainab. Good morning.
Good morning. Thank you for having me, and it's a pleasure joining you on Business Morning.
Good to have you, Zainab. So help us understand this risk that's captured in this index. Of course, we do know that the world was trying to get out of the after effects of the COVID pandemic, and then we now have this Russia-Ukraine war, which is hitting us on all sides. But help us understand, especially as it has to do with Nigeria, what are the risks that we're facing? I know recession is one of it. We just discussed it in the other segment. But help us understand more about the risks.
Thank you so much. So what we've done under the Risk Reward Index is to track the investment landscape in major African markets, including Nigeria, and provide a longer-term outlook of key trends shaping investments in these economies. So based on our findings each year, we then assign a risk and reward score to each country. The three outstanding trends that we've looked into in this year's report, which, as you mentioned, are mainly driven by sustained economic shocks from the COVID pandemic and the Ukraine conflict. We're looking at one, uncertainty around the energy transition. We're looking at rising food insecurity and the groundswell of political discontent across African countries. So with the energy transition, we're seeing African countries navigate a global wave of energy diversification. And this was mainly triggered by the recent start to the Ukraine conflict earlier in the year. And they're looking for new ways to address local demand, for mainly imported energy sources, such as refined petroleum, which I'm sure Nigeria imports quite heavily. And at the same time, they're also trying to position for potential roles as key suppliers, potentially to Europe and other parts of the world. With food security, we're also seeing global supply challenges, have been worsened based on the continent's broader supply chain deficiencies. So most countries, including Nigeria and other African countries like Ghana and Sierra Leone on the continent, are heavily reliant on the importation of key staples. And COVID and now the conflict in Ukraine has exposed this reliance, and it's sort of triggered exponential hikes in consumer prices over the last few months, especially in low-income nations. And this has then sort of segued into the third risk that we're looking at, which is political discontent. And so because of the rising cost of food prices, we're then seeing rising cost of living across the continent. And then we're also then seeing this instigate a wave of citizen frustrations. And this has been mainly targeted towards their governments, who have limited resources right now to cushion the impact of the inflation that their countries are facing. Nigeria, I'm sure you're aware, has gone above 20%. Ghana has gone above 30%. Zimbabwe is almost 250% in terms of inflation hikes. So because of these revenue constraints that the countries have and existing public debt, most governments are struggling to address these inflation hikes and the hikes in cost of living. And this has then triggered, discontent, protest on the streets, military interventions, and increased participation in political processes. Now, these trends have now sort of come together to exacerbate global uncertainty and the view of growth opportunities on the African continent. And that's what the report in a nutshell looks at, various ways in which African countries are dealing with this and potentially lucrative solutions that businesses can then bring to the table to support African governments with addressing these issues.
Yeah. So you mentioned energy transition. That's like one of the burning phrases going on in Nigeria, around the world. And we do know that in countries like the UK, in the European Union, energy prices is a major driver of their inflation at this time. But it seems like back home, how prominent is this issue of energy transition? How important is it when we look at the scale of things, you know, with the pandemic after effects, with the Ukraine war? Is it what we should be looking at? What do we benefit or lose if we do not prioritize energy transition at this time in Nigeria?
Well, I think with energy transition, it's really almost a catch-22. So you have a lot of countries, including Nigeria, that have made global climate commitments. With Nigeria, we made a commitment to get to net zero by 2060. But then countries like Nigeria then have to balance their climate ambitions with the economic realities of being a hydrocarbon-reliant country. You know, so our economy is benchmarked based on the amount of oil that we're able to sell, and the government is now slowly realizing that that's not sustainable and moving towards non-oil resources. But for now, for short to medium-term sovereign financing, we still have to rely on oil and the revenue that we get. Now, the strategy that we've seen the Nigerian government, for example, do is rely on, you know, crude oil. We're seeing record crude oil prices, and the government is relying on that to generate, you know, enough financing to support, you know, its budget expectations for the year and likely next year. You know, but in addition to that, the government is also looking for opportunities to use existing, you know, resources like gas to then open up, explore new markets. So I'm sure you're aware of the Trans-Saharan gas pipeline, which the Nigerian government has recently signed an MOU with the Niger Republic and Algeria, and there's also the Nigeria-Morocco gas pipeline. So the idea is that, you know, we currently have, you know, short-term financing issues that we have to address with oil. We also have long-term opportunities that we really can't leave money on the table for through the gas pipeline, you know, situation. So it's really depending on the direction in terms of what kind of energy financing the country can get to address its energy transition plan. So the projections under the plan, which I'm sure you're aware the government released a few months ago, was that the country would need around $400 billion, you know, to essentially transition from energy sources like oil and gas. But then at the same time, it then has to balance potential opportunities in markets like Europe and North America, and what it can get from selling its gas resources to those countries. So I think that's where we are in terms of, you know, Nigeria and its position on the climate change.
Yeah, well, the truth is, the reality, I mean, you mentioned $400 billion. I know South Africa has been trying this energy transition for a while, and it gets even more difficult because coal is at the center of electricity production. And then back here in Nigeria, yes, you mentioned the pipeline projects, the Morocco, and all those things are investments that require funding. At a time when our revenue cannot even take care of our debt servicing. So, you know, it just seems like far-fetched. Like it's something that we're just saying because the world is talking about it, because the reality on the ground is the government is borrowing monies for salaries. So how do you now invest in this long-term infrastructure?
And I think that's part of what we look at in the risk-reward index, because what you've described is a perfect example of the kind of challenges that businesses can then come into the country and partner with the government to invest in. I don't know that the government's expectation is that it would spend $400 billion itself. The expectation is that it would partner with potential investors, with potential development finance institutions, to support the creation of innovative homegrown solutions to help it transition from energy, you know, like oil and gas, to other renewable sources. So in terms of the reward part of our risk-reward index, those are the types of opportunities we look at. So we look at things like conventional energy sources, not just oil and gas and setting up refineries, but also looking for ways to provide renewable energy sources in country, so solar power, wind power, biofuels, opportunities like that are bound in countries like Nigeria and indeed other African countries where energy poverty is a major issue. You're looking at statistics saying at least 2/3 of the continent struggles with energy access. That is a huge market because we're talking about a continent of 1.4 billion people. So if you have a business that's looking to come into Africa, that is one potential solution that they could look at to partner with governments to resolve.
Well, partnership would require certainty for investment. And you and I talked about uncertainty at the beginning of this conversation. So that's a discouraging factor. For Nigeria, the issue of insecurity. We're talking about oil theft and vandalism now. At the pipelines. And now we're talking of attracting investments, you know. So we need to be able to assure them that their investments are secure and that they have that security, you know, at the pipeline, even this infrastructure that we want to develop. So, I mean, how do we cross that hurdle to tell them, yes, we are having problems with vandalism and oil theft now, but it's not going to affect your investment even when you do the Nigeria-Morocco pipeline and Maghreb. You know, how do we cross that hurdle?
100% agree with you that that is a challenge. I think on the government's part, what is important is for governments to understand how to create, we talk about it a lot, enabling environments for businesses to come in. How do you do that? You're looking at the creation of proper policies that are targeting these businesses and allowing them to come in, proper regulations that are targeting these companies and allowing them to come in, putting together the kind of infrastructure, roads, security, you know, access to utilities that allow them to do that. I do agree with you that part of the challenges is that most African governments, including Nigeria, do not understand how to get that done. I mean, just a few weeks ago, we heard that the National Assembly was asking the Ministry of Finance and other revenue generating agencies to review tax waivers and import duty waivers just to be able to shore up our revenues. We are aware that the Nigerian government currently has revenue constraints. Now, what that signals to investors who are looking to come into the Nigerian market is, you know, you are disincentivizing, you know, those types of sectors that they would come in, have to bring in expensive equipment, have to bring in, you know, a lot of technology just to support the setup of factories and industries in this country, and they would look elsewhere. So they would then go, you know, country shopping for those countries that have the most favorable investment policies, the most favorable regulations, you know, that would help them do that. You also touched on security. That is a major issue, especially with the agricultural food chain, and it's part of what's driving food insecurity in areas like, you know, the Middle Belt in Nigeria, where you're seeing, you know, floods, you're seeing conflicts around, you know, cattle herders clashing with farmers, you're seeing bandit attacks on farmers. It's just increasingly becoming difficult for smallholder farmers to go into the farms and, you know, harvest their crops, not to then talk of major commercial scale industrial farmers who would be looking to set up, you know, farms which would hire or employ thousands of Nigerians, you know, and produce, you know, enough food to help us deal with our local consumption. So it is a major challenge, and I agree with you. And I think, you know, the solution is in governments, the Nigerian government and other African governments understanding, you know, that it's a win-win situation when you create, you know, an enabling environment for investors to come into your country because they're helping you solve problems that you're looking for solutions to.
All right, well, Zainab, I guess you captured it there. There are so many hurdles that the government has to cross, or so many things to put in place if we really want to attract those partnerships, which we know we have the potential for, but we have to be
Absolutely.
able to you know, allay their fears that their investment will yield what we promised them. Thank you so much for sharing that findings with us. Zainab Animashon, Senior Analyst, Control Risks.
Yes.
Enjoy the rest of your day.
Thank you so much for having me. Have a good morning.
All right, now it's market time. Now we have Anita Edits joining in. Hi, Anita. Good morning.
Good morning, Amy.
Good to have you.
Yes.
How's the markets?
Well, let me just tell you.
Still reacting to the Federal Reserve?
I won't call it the Federal Reserve. I'll say profit-taking, and then at the same time you had a markdown of GT.co's shares. So what more of profit-taking and the Nigeria's macroeconomic environment, which is not too...
But Anita, are you sure? Because, I mean, we do know that since the dollar is getting stronger, we would have people leave emerging economies and go to where they can invest in, you know, gold and things that are connected to the dollar, so they can hedge.
Yeah, well, you know, the hedging is on one side, but at the same time, I would say maybe investors are a little bit wary of the local stocks. So at the moment, we don't see that positive sentiment coming into the market, but we will get more analysis from our analysts
for the day.
In the course of, yes. So now, with that being said, this is how the market closed at Wednesday's trading session. It was down by 12.62 billion naira in terms of naira value. It's down to about 26.657 trillion naira, and there you have it. The all-share index is down by 0.05%. So it has erased the marginal gain that you had on Tuesday, the 0.01%, which was driven by some banking big names, of course. So, but as of yesterday, we had a markdown of GT.co's share price, which also contributed to that investors' lackluster sentiment. At the same time, First Bank of Nigeria, FBN Holdings, to be precise, was the major reason, as well as Lafarge WAPCO. But take a look at the board there. The banking sector, it was up by 0.49%, which is almost half of a percent. But here we have oil and gas was down, insurance as well as industrial goods counter, like I mentioned, Lafarge WAPCO, and some other key components on this 5 sectoral indexes of the NGX. So that's why the market went down at the close of Wednesday's trading session. But let's flip over to the activity chart. There you can see it's still, as a matter of fact, the market's value has never been this low. It was down by more than 75.35%. There you have it. Just about 590 million naira was staked on equities. Just about 51.87 million units of shares was traded there. So that value was down by 64.85%, in contrast to what you had on Tuesday. As well as the total number of deals, it was down, the total number of deals, it was down by more than 8%. So it just tells you maybe investors are wary of buying shares. But to give us more insight into that, let's talk to our equity analyst, Richard Akimoladu. He's an equity trader at CSL Stockbrokers. Thank you for joining us, Richard.
Thank you, Anita, for having me on your program this morning.
Yeah, and I'll say welcome back from your vacation. So now, as you are a trader, can you tell us what is the reason for the market's continued downturn, particularly when you look at the month-to-date gain is down again to minus 0.8%, and at the same time, the year-to-date gain is still positive, but lower at 15.8%. So give us more insight into this.
Thank you, Anita. As you rightly mentioned, we continue to see weak sentiment in the market. We continue to see sell pressure, volume and value continue to decline. And if you look at the half-year result that were released into the market, we saw at least quite some good numbers that came to the market. The major concern of the market is the headwind, the macroeconomic headwind that are actually playing in the economy, and they are having a very significant effect on the market. We have the high inflation, the last inflation number that was released, inflation at 20 points, above 20 level, and this is putting pressure on the investment, the local investors, because their real return is going into negative territory the more. And also the FX, we keep talking about this, the FX challenges, the FPI are no longer in the market, the PFA are no longer, they are not actually playing the market, and the political environment we are now, the political risk. So these are some of the headwinds that are actually having effect in the market. Though we have some good news, prices are low now, and as I mentioned, that results, especially the half-year results that were released across all sectors, were positive. And I believe this sentiment might continue, but at a point we might see a turnaround soon.
Okay, so now with that being said, in a couple of days from now, precisely by next week, we will be approaching the end of the third quarter of 2022 and then bracing for the final quarter of 2022. So what's your outlook? Do you still see, you mentioned something about the election pressure as well as inflation. So what's your outlook for investor sentiment for the market in the coming quarter?
We might continue to see this weak sentiment in the market for now, bearing in mind that the market now is majorly dominated by local players, and I'm not sure they have that financial muscle to actually move the market in the direction we want until some of these headwinds that I've mentioned earlier, until we begin to see a positive turnaround around those headwinds before we might see any significant positive move in the market.
Okay, thank you, Richard, for that analysis. And well, we'll keep our optimism for a rebound in the market. So that was Richard Akimoladu, equity trader at CSL Stockbrokers. So I don't know what your take is for the markets.
I think I'll keep my optimism for a rebound.
Exactly. That's the only way to go.
Yeah, thank you so much, Anita, for that. So we'll take a break now. When we come back, well, it's decision day in the UK. Juliana will fill us in after the break. This is Business Morning on Channels Television. Welcome back to watching Business Morning here on Channels Television. So it's decision day for the MPC in the UK. We have our correspondent in our studio in London, Juliana, standing by. Juliana, good morning. It's a day to watch today, I see. And then, unfortunately, the pound is not looking so healthy at this time from yesterday.
Good morning, Innie. Well, that's absolutely right. In fact, I think last week the pound hit a 37-year low against the US dollar, which is why there is so much pressure for Andrew Bailey and the rest of the 9-strong Monetary Policy Committee group, who will be gathering probably about now at Threadneedle Street to update us on interest rates. Of course, the meeting was to take place last week, Thursday, September the 15th, but because of the national mourning for the Queen, it was decided to be pushed forward. There are high expectations, of course, because we know inflation is really crippling the UK economy. Lots of people not spending as they used to, which is why we are potentially heading into a 5-quarter recession. Interest rates in the country are currently at 1.75%. They have been raised 6 times in a row, 6 consecutive rises. We're expecting a 7th today. And now the odds on bet are just how much Andrew Bailey is going to go. Is it going to be the 0.5%, which is what we've seen, or is it going to be 0.75%? And if it is a 0.75% hike, that is the highest hike we've seen since 1987. There are some factors that are going to influence the MPC. Some of them are to do with this new UK energy price plan. A couple of weeks ago, Liz Truss, the Prime Minister, decided, she kind of did a U-turn and said that energy prices will be frozen to no more than £2,500 for the next 2 years, starting from the 1st of October. Now, one of the reasons why we have had high inflation is because of the soaring energy prices. And Liz Truss has said, because she's going to be freezing that should bring down inflation, which could mean that the BOE don't need to hike it as much. So we just have to wait and see. But then, of course, there is a downside to hiking interest rates, and that is mainly to do with the cost of borrowing, but particularly for the 4 million individuals who own homes on mortgages that don't have a fixed rate. So they, as well as seeing their wages stagnating, as well as seeing costs in the shops going higher and their bills being higher, they are going to see their mortgage rates surge. So it is a delicate balance. But of course, when you're paid as much as Andrew Bailey, you should be able to tackle these delicate balances. So all eyes are going to be on 12 o'clock noon local time when we'll get those results.
Juliana, yeah, if you're paid as much as Andrew Bailey, should be able to think out the solution. But there's also another issue, which is the issue of debt. I know back here in Nigeria, it's a major one. And over there in the UK, you have the Institute for Fiscal Studies saying it's unsustainable at this rate.
Well, yeah, we had Office for National Statistics delivering data saying that in the month of August alone, the UK government borrowed about £11.8 billion. That was double what was expected. And there are some concerns on the eve of Kwasi Kwarteng's mini-budget. The Chancellor, he is going to be announcing just how we're going to be getting through the winter tomorrow. The Institute of Fiscal Studies, which is a very influential economic think tank, they have said, look, you know, hold your horses. This public sector net borrowing is unsustainable, and they have cited Liz Truss's economic plans, which include reversing April's increase of national insurance by 1.25%. She said that's going to be scrapped. Also as well, corporation tax, which is a big issue affecting not just the UK but all around the globe. That was supposed to be increased next year, I think, to about 25%. She said she's not going to increase that. But if you're not going to increase those two tax hikes, where is the money going to come from? If you go into the public purse, they estimate that it's going to cost about £30 billion extra a year. This is separate from the £2,500 tax freeze and yesterday's announcement of giving non-domestic residential buildings a 6-month freeze on their energy bills. This costs a lot of money, and there are concerns that if we keep going in this way, then certainly one day Britons are going to pay for it. And austerity is one thing we don't want, but of course, constant borrowing is not great too. So yeah, lots of issues Liz Truss has to face on her way back from the UNGA in New York.
Yes, well, she went for the job, campaigned for it. I guess she can handle it. All right, Juliana, talk to you at 1:30, yeah. Okay, lots of things for leaders, economic leaders and country leaders to handle. It's not different in Nigeria. Neither is it different in the crypto space. I mean, it's a deregulated space, so we may not have anyone to hold on to, but we do have eyes there. So let's head to the crypto market now and see for today the Fear Greed Index. Has it gone up? Has it gone down? Has it gone up? Has it gone down? No way. Not when the Federal Reserve has hiked it, so they're very sensitive. The market is really sensitive and just reacts. Whenever the dollar is boosted, it just goes down. So there at 22, even though, I mean, the 75 basis point had mostly been priced in by a lot of markets and economies even before now, because analysts had been saying to be between 50 and 75 basis point, but we still see that the Fear Greed Index has not really changed. It's extreme fear. Just a little bit different from what it was yesterday at 22. And the price of the market cap first is down also 0.70% at $912.30 billion. 24-hour volume higher by 35%. And then Bitcoin dominance a little bit better than this time yesterday at 39. Yesterday it was about 38. Let's see the price of Bitcoin there. Don't expect anything less, do we? Down 0.38% at 18,765.81. 24-hour volume 49.58. And the price of Ethereum is also down much further. More than 4% compared to this time yesterday, 1,267.72, and the 24-hour volume 21.78. Let's see if we have Gilbert Jopata. That's the top alt by market cap, up slightly, just really slightly, by 8 a.m. today. BNB, Cardano, eCash, and then XRP. Let's see if we have Gilbert Jopata now to tell us more reactions to this Federal Open Market Committee meeting as Federal Reserve. Hi, Gilbert. Good morning. Receiving more bashes, we see Bitcoin and the crypto generally.
Yeah, good morning.
So we see more reactions from the Federal Reserve's decision yesterday.
Yes, the market actually traded lower pre-FOMC meeting to the widely expected 75 basis point hike. However, during the meeting, the expected rate was already priced in. Optimism grew as reflected on BTC's 1-hour chart. We grew to about 19,900 before reversing to the current level. But I still think short-term traders should still be snake-bite careful because the market is technically seated on a cliff, while on-chain also shows that about 16,000 BTC has been moved to centralized exchanges. So anything could and anything will happen on the balance of probability. There may be a further spillover to the downside. However, the central bank's view on the economy, CPI and funding rates, I believe is even more important than the present rate because they are committed to bring inflation to 2%, while the federal funding rate is also projected to grow to 4.4% year on year and close at about 4.6% by 2023, indicating that there is also more aggressive rate hike on the horizon. And we may also have a test of it before this year ends.
Well, that's 2% target. I mean, it remains a worry because the more they hike the rate, the more they squeeze out liquidity in the economy and reduce production and economic activities and revenue. But let's stay on Bitcoin and see, there's a conversation of Bitcoin adoption, a mainstream Bitcoin adoption. How's that going?
Okay, so far, there have been remarkable growth in terms of adoption of Bitcoin from countries. We also see countries like El Salvador, they are now involved in the mining of Bitcoin and they are generating profits from this mining, which is used now as part of the government's reserve and fund used to better the economy of the nation. So there is more to gain even from countries taking advantage of not just using Bitcoin as reserve, but also going into mining. But I think there are actually certain things that may look like a barrier, which I actually think is user education. When I mean user education, majority of persons who come to the industry come through using the crypto market of Bitcoin as an investment vehicle or as a speculative instrument. But we need to move to the point where we understand that cryptocurrencies are just native tokens, but these projects actually present real solution to the marketplace and our real life. They are projects for insurance, healthcare, finance and the rest. We need to move to the point where we don't just use cryptocurrencies as speculative instruments and investment vehicle, but we use them for the real solution they provide in the marketplace.
All right, Gilbert, thank you so much for that. Certainly we'll follow even those countries that have adopted Bitcoin and see how successful it's been so far. But enjoy the rest of the day. Thank you for your time.
And you too.
Well, that's it on the program for today. Thank you so much for being a part of it. Being a 55-minute journey, 55 or 56. We'll have another one tomorrow. So if you missed out, well, you can go to our YouTube channel and see how it went today. And then tomorrow at 10 a.m., you can join us for a fresh episode. But at 1:30, I'll be back with Business Incorporated to give you updates from the world of business. I'm Ini John Mekwa. Have a profitable business day.